Okay, great. So we're looking at our stock market calendar, and we're basically right before. Let me see. Today is May 26th, so we're right here. Okay, we've been saying for a month now. We've been waiting for the holiday, which is on Monday. So everyone's going to have a nice Memorial Day picnic, and there's good vibes. And there's a low volume because people go on vacation right before holidays. So combining all those things, we were saying for a while there should be, nice feelings. We have a debt ceiling that probably is going to be lifted by the government. So that's another warm fuzzy in everyone's stomach when they're investing. Um, so we have seasonal factors not working into our favor though. June is traditionally a poor month for the stock market, primarily because there's no earnings coming out. There's not a whole lot of news, and in general, most companies don't make a lot of sales in the summer months. They actually make most of their money around Christmas time. So that's why you have a seasonality of a bad. Let's look at our seasonalities. Yeah, so we're going into June. June is traditionally one of the worst months of the year, and August, September are the absolute worst months. So we know that. That's why we're not expecting too much out of the first couple of weeks of June. But we do have a Fed meeting coming up in June 14th. And that's whenever interest rates, actually the futures that track this, and the experts that actually, put money towards these things based on what they say it's going to be raised another quarter point. So, and they might make a statement at that time that this is done, that the Fed tightening is done, and that could spur like a rally. We also have end of quarter window dressing every 4 months, every 3 months. It's the end of a quarter. 4 months. 1, 2, 3. Yeah, every 3 months we have an end of quarter window dressing, and that's when the last week or two of the year, a lot of the money managers try to pad their portfolios to make it look like they've owned all of the good stocks that went up. So you expect companies like that are really high performers this year, like the big tech stocks, to be bought up in the last 2 weeks because those have been doing really good so far this year. Okay, what else do we have? We have triple witching. That is going to happen the third week of June. Very volatile day. That's when all the expirations come in one day for options. And what else? Yeah, so expect if it goes up or down, around these two dates, it's because there's some options that have to be either exercised or stocks sold to meet demands of the options. All right, so now we have, we were expecting a couple good days here because of the holiday and because there's a 99% chance. I said 90 last week, but the United States is not going to default on its debt, so there's going to be some kind of compromise and a deal made. And let's look at the S&P 500, where we are. We actually are still in this trading range for this year, and it's not breaking out. We're very close to the top of the range, and it seems like we're in an up channel, but we're still in a sideways path for earnings. We're nearing the prior resistance from prior months. Let's look at the actual real-time S&P chart. Hold on, it'll be worth it. We're going to look at that screen. Okay, so whenever you look at the S&P, most stocks follow the S&P, And we have higher highs, higher lows. You can see that, right? And if we hit another high up here, that's a really good sign that we're in an uptrend. Right now we have higher lows, and what we have to keep in mind is there is prior resistance. This is going back a couple years, but if we look at since last year, this is 2022, we have this resistance level where we're at right now. You can see at this time in August of last year, we didn't break through that. We have the same time right here. This is called resistance. So the whole market is kind of watching these prior highs, and that a lot of times, if we don't have earnings going up, we're just going to be in a range. But we noticed right around this time, this was the October lows. If we have anything catastrophic in the stock market, this is the prior support, and that's if there's like a crash in the stock market, we're going to hit these prior levels of support like 385, 376, and 357. The reason why we're going over this is that all stocks trade with the S&P, and you just have to be aware of these levels so you don't get over your skis. All right, so now that's a good exercise. Now let's go look at the. See, we are currently 43 in the stochastics. That means we're pretty much getting to a point where we're oversold. That's below 50. When it gets down to 20, that means we're basically in oversold territory, and that's usually an indication it's a time to buy or not sell. Okay, so. And we had, I guess, in general, the general psyche of the market right now is the market is afraid of increasing interest rates. If the interest rates go up substantially from where they are now, that'll make the stock market go down. And the other intangible is the debt ceiling or anything the government might cause any kind of problems with the United States dollar, and that affects every company that we're following. All right, so let's look at our talking points. S&P was unchanged since last week, believe it or not. We have a lot of ups and a lot of downs. The stock market's been basically, it hasn't done anything in a week. NVIDIA came out with better than expected earnings, and they went up 25% yesterday. The big news from NVIDIA is AI is becoming basically the next internet. I mean, everyone compares it against the internet because the internet was one of the biggest tech innovations of the 2000 time frame. Just like the locomotive was the biggest innovation in the 1800s. So now we have AI is turning out to be like a super game changer, and NVIDIA is becoming a supplier to that industry. They have chips and a software stack that is sold together that companies use for their data farms and the data servers. So I think that's the interesting thing I saw. You see, let's go back to, hold on. Here's something I saw about NVIDIA. Kathy Woods and their ARC Innovation Fund. Let me see. Hold on. Look at this. Kathy Woods actually owned a lot of NVIDIA, and she sold out at the lows. And look at where NVIDIA is now. So it's turning out that Kathy Woods for the ARC Innovation Fund is turning out to be a loser and a zero, not a hero. And she's making some very bad financial decisions for her fund, it seems. So a lot of times you got to do the opposite of what other people are saying. And one thing, this guy's pretty good. He keeps track of people, and he said Jim Cramer said you should not buy a dip, that's right around. Jim Cramer said, "Don't buy tech right here," and that's exactly when it went up. And so you have to think as a contrary as an investor. And right now, people are pretty much scared, and they're the United States defaulting, a lot of issues like that. But the thing with NVIDIA is we've been following it for a while. They started out in gaming, and then they got into cryptocurrency chips for that industry. That didn't, and that fell off the wayside. But their AI chips are becoming super high in demand, and there are some people that say this is a 10-year. Well, the CEO said it's a 10-year time frame for their rollout of AI chips. So we're going to be following NVIDIA. We're going to do a deep dive on that company to see, where their current estimates are. They're probably going to change because we don't get updates immediately. It'll take a while for analysts to look at what they said in their call and everything. But NVIDIA is turning out to be one of the better performers in the past 10 years, and they just became a $1 trillion company. So anyway, Memorial Day is this Monday. So markets, we've been saying this for a while, markets usually go up before holidays, and because people are all happy and they have a little time off, and that gets them more energized. Now let's see, the S&P, I guess most of the S&P companies have reported already, so there's nothing really in the next month or so for catalysts for the stock market to go up. So expect sideways action and maybe geopolitical issues, maybe to move stocks up and down, but there's nothing really happening news-wise. That's why June is usually, not positive. Okay, so now the Fed is near the end of their tightening, but they're saying that they'll raise it one or two more times. So the 10-year is it's up 8%, and the 2-year is up 16%, and that's primarily because this U.S. default problem. Whenever there's a possibility of a default, whether it's or any other kind of bonds, there's less people willing to buy those, and the rates go up. So that totally makes sense that short-term rates are going up with these. So if we default on our debt in the United States, the rates for each of these is going to go up substantially because less companies, corporations, and countries, central banks would want to buy United States debt, and that make it go up like to 10% or something. So, but this is really important in investing because these rates basically are alternatives to stocks. And if you have a sure thing paying 10%, and then you have to counter that with, do you want to take a risk in stock investing? All right, so catalyst for the market to go up. Debt ceiling deal, it's going to happen. But as soon as it does happen, we could have a buy on the rumor, sell on the news. So right now, people are excited possibility of a debt ceiling deal whenever it hits. There's a good possibility that when the news hits that we have a deal, the stock market will sell off. So that's buy on the rumor, sell on the news. So that's contrary again. Almost everything in the stock market is almost opposite of what you would normally think it should. If stocks are going up, you want to buy, so it keeps on going up. But just when you do that, stocks go down. So you have to think as a contrary investor. So Fed is nearing the interest rates. Yeah, interest rate hiking. To stop doing that. Let me see what else. We are getting momentum in the market. The largest stocks have carried the market so far this year, but if we get more follow through from other parts of the market, and there's a little momentum there, then that will help really make. Right now we're at this intersection of, well, are we going to be in this range or this range here, or are we going to break out of here? So we're at like an inflection point right now. And most likely the earnings aren't going up for the S&P, so it probably stay in this range. All right, so let's look at other things that are going on. Oil is up a little bit this month. A lot of times they look at the China market. If the China market is improving, then the demand for oil goes up, and that means the price of oil goes up. But if right now there's a possibility of a COVID issue in China. So if there is a COVID issue in China, that reduces the amount of demand for resources like oil, and that means oil price will go down if that happens. And there's a certain amount of output and global economic activity. If China is locked down for COVID, then that slows the world economy down. So the economy slows down. That means the price of oil goes down with it because there's less demand. All right, so inflation, that hasn't changed. U.S. dollar is actually up 3%. Might have something to do with this debt ceiling issue, something I don't know, I can't predict that. But gold is down 3%. So I think there's a flight to quality with the U.S. debt crisis, and as there is a possibility of a resolution to that matter, the price of gold will go down with that, because people don't need to hedge and get into something consistent over time. All right, so now let's look at so far Dan Now's beginning of the year prediction is coming true. We're staying within this range, and until the S&P earnings go up, the earnings projections go up, we're going to be stuck in this range, it seems. Fear and greed. We're getting more greedy. Last week we were at 659, which is right here, and we're getting more greedy. So that's a good indication that we're going to when people are greedy, you want to not buy, and when people are fearful, you want to buy. So right now people are just overextended. Let's look at the VIX. VIX is down. So as the stock market goes up and there's more certainty, the VIX goes down, and people looks like right now we're still in this bull market. And when we look at our stochastics for the S&P, we can see that we are in an uptrend, and we're making higher highs, higher lows, higher highs. So, and we have a bullish kind of indication in the market. Now, if we have a major market moving event, such as another war starting, or possibility of a U.S. default in their debt or something like that, then we have to go back and review all of our holdings to make sure that they're not going to be changing in value. But right now, VIX is really low. People aren't afraid, and they're in bull market mode. Let's look at our our emotional graph. So right now, it seems like we're greedy. That's like the stage where we've already been through a sell-off last year in a lot of the big stocks. Right now, we have some momentum, like we just saw in the S&P. We see the a lot of lower highs, lower lows. Higher highs, higher lows. So hold on. Right, so we get to this point where we're greedy right now, and we're going to the summer doldrums. So don't be surprised if we go into some kind of major news story that causes people to be fearful. And June, maybe the September, we have some capitulation, and then around Christmas time, we're going to be returning to the normal, and people are going to be happy about the holidays. So you have to get used to this pattern, because you don't want to buy whenever people are fearful and the stock market's going down. But you got to look at the 10-year time frame and know that these you got as a adult investor, you have to be willing to go through these emotions and just block them out, basically, and have a long-term viewpoint. So for NVIDIA, we're going to be looking at NVIDIA today. Yeah, NVIDIA had better than expected earnings. Let's look at their NVIDIA explodes after guidance for the ages. So basically, they gave an indication in their conference call and in their earnings report that there's a big shift towards generative AI and accelerated computing. So all the data centers, it seems like data centers might need to switch to a large portion of this type of chip that NVIDIA sells, and there's a super high demand. And they said it's a 10-year transition period. So this is the beginning, maybe, of a 10-year cycle where people are upgrading, data centers are upgrading to this new technology. So this generative AI could be the next internet. We don't know, but NVIDIA is the picks and shovels. They say that because in the old times, you had a gold mines in California, and there's two people that made money, the ones that are digging the gold and the ones selling the shovels to dig the gold. And in this scenario, NVIDIA is selling the actual hardware to allow AI to happen. So NVIDIA's thesis is they're at a new frontier with this AI, and they're making processors used by the AI data centers, and they provide software and the chips, and that's where they have like an edge. So we'll be following right now. The estimates from E-Trade aren't necessarily reflecting what they said on the conference call yet, but because they only have 25% earnings projections for the next couple of years. But I think this will change as the earnings estimates are revised up. But they basically said they're growing 60% year over year. So I put 60% temporarily in that number, and they have a P of 158, and that might change. In a week, we'll come back and it'll be 55 because their earnings were so good this quarter. It might change all these. So right now our numbers aren't necessarily reflective. It seems like they're growing at 60%, and their PE is around 55. I took a guess at that because it'll take a while for this to be updated. So they're possibly fairly valued right now, and they're growing at 50%. So that's pretty good for a growth stock. So we'll update this as the earnings come in. But it's interesting to see that how this stock could be so. We were looking at it before, and it seems so pricey because the PE is 158, and it was higher last year. But as earnings come in for this new type of product, it makes their PE more reasonable. So I checked in with Morningstar, and I checked in with CFRA. CFRA, no, this is Morningstar. They said the fair value is 300. Let me see. Their data center segment is growing at 30% a year, and there's a large demand for their new data center GPU. So let me see. There's a lot of analysts that are increasing their price targets. It'll take a week for all that to settle in and get into our numbers. So they're basically also saying that it's a 60% year-over-year growth for this new product that they have.
And so one thing they haven't mentioned would be the cost of investment into the new initiative, right? They're gonna build a new lab. They're gonna build a new application stacks for AI. That costs money, right?
Yeah, I think they've already done that.
They just announced. They don't have it yet.
I think they have
a 10-year initiative, right?
Yeah,
it's not gonna happen overnight.
They have an existing solution, a software stack.
Not for AI.
I think they do.
No, that's a 10-year initiative.
Oh, okay. Maybe they don't. I'm not an expert at this, but we were saying last year when we were looking at this that they were actually coming up with, an AI for the metaverse, and that might have been an application. But it seems like the metaverse is dying inside. It'll probably never come to fruition. But this is kind of using the same technology. Like they were talking about a chat agent in the metaverse where you can go and talk to a JP Morgan Chase representative talking in an AI, using an AI backed server. That was one application of this, but now they're basically repurposing that for this environment, perhaps. I'm not sure about it, but
ChatGPT only mature within mid-year time frame, so any adaptation will take time.
yeah, I think
That's the reason I bring it up. I think I'm kind of wondering how much of that price jumps on stock is a hype, and how much of that will be remaining, will be sticking around.
Yeah, it went up 25% yesterday.
Right. So how much of that will fall down to us?
I'm thinking half of that could have been shorts that are covering. Whenever a stock jumps up, a major stock jumps up 25% in a day, or any stock, you got to think about, it was in a downtrend all last year.
Right.
It's up 100% this year, or more, 150%. But there's a certain percentage of people that are pressing shorts whenever stock goes down. And when it goes up 25% in a day, there's a lot of covering. You can't really take that. The first thing as an investor, you see, oh, it's going up 25%. It'll probably go up another 25%. And then you have to not do that, because whenever you think it's going up, that's called feeding the ducks. Whenever you see a stock open up in the morning 5%, you buy it, and then the seller, the actual people that know what they're doing, they feed the ducks, they give you this 5%, then they sell it, and then it goes down. So you have to realize these 25% gains in a day are a little bit because of short covering and because people are repositioning based on the news. So
the analysts will eventually update the fair value, but I doubt they will update to the current price range.
There were some people on CNBC yesterday that were saying that the stock is cheaper today than it was yesterday because the earnings were so good. It cut the PE in half, and it made it so that it'll take a while for us to really see the numbers update because we don't pay for real-time stuff. I don't. But we just have to see how this, and sometimes what they were saying, this altimeter guy yesterday, he invested in this in December and January, and he was basically saying you have to look at a 10-year time frame. You can't rely on these estimates, like they're golden, because they don't really have the vision that you have, for some of the initiatives that are happening. And we're going to go over Tesla a little bit later, just to see the similar situation where, some of the estimates that are in, that analysts are using aren't taking into consideration some of their offerings that might happen in the future. Google's the same way. They have a lot of moonshots, and there's a guy named Ackman that said he bought a lot of Google because he sees some of those moonshots actually coming to actual real products in the future. So a lot of times you got to have a faith in, the company and the CEO and the management. And it turns out that this, it's not a good idea to buy, when it's up 25% like that. But whenever a good stock is, down, you have to look at their long-term, like Tesla is actually a stock right now that's down a lot. It's been going in a downtrend for over a year. And there's some news today we'll go over that, that could make it, in the long term, more and more closer to fair value. But so I like to keep, when I'm investing, I want to I want to see these numbers make sense for me. Like if it's undervalued, if it's a PEG ratio of less than 1, and it's a quality company, I'm going to start looking at it. But right now, we still don't know with this company. We just have to see the numbers updated. We'll update it maybe 2 weeks from now. All right, so yeah, the numbers aren't up. Yeah, so it seems like some of these numbers for Morningstar and CFRA aren't updating yet. But CFRA says it's double the value it should be. I mean, it's overvalued by 31%. So, and I looked at their earnings over time. It's not that consistent. I would expect it to be growing, in a straight line, maybe up 10% or more a year. But it's a little bit inconsistent. That's probably because the semiconductor industry isn't, it goes up and down with the economy. So I guess it has to do with that, but I don't know. We'll check in with it after a while. I like to see all these numbers going in a straight line, and that usually indicates you have a steady demand over time, and that's what Warren Buffett likes to look at. So we'll check back with that after a while. But it is on a roll this year. It started in November, and we're definitely in an uptrend, and we're at the top of that trend right now. So it'll probably sink back into this range where it's going to make higher highs and higher lows. Okay, so here's another article that it's related to that. Bill Ackman. We talked about Carl Icahn's stock, IEP. It's his personal hedge fund in a ETF. And we were saying it doesn't really make a whole lot of sense to us at that time. That was like a couple months ago. And now there's a short seller that's actually targeting that stock like he was, it could be totally fraudulent. And Bill Ackman mentioned he has a big bet on Alphabet. So he basically is saying that Alphabet's earnings are tempered by losses on certain bets that might eventually pay off big. So we know they have Waymo, that's the self-driving car. They have cloud computing and AI that isn't really public at this time. So there's a lot of different initiatives that might actually turn out to be that might help them, in the growth in the future once maybe search isn't as good in the future. But right now, the interesting thing about Alphabet is Charlie Munger said they probably have the widest moat of any company that he knows. So they have over 90% market share. That's really hard to fight. They have a lot of lawsuits from the governments for monopolistic activity, but it seems like those have been going on for 10 years now and nothing's happened. So it's really good when one of the stocks you're following is being looked at and bought by like a world-class investor like Bill Ackman. So he bought it around like $90 a share, and right now it's 120 something. So that's a good indication that if or when Alphabet goes back down to the 90s or 80s, it's a good time to start looking at that one as a long-term holding. Here's another article. It's on Ford CEO saying Tesla superchargers may become standard for EV charging. So basically there was a deal between Ford and Tesla and to use Tesla's superchargers for Ford vehicles. Okay, so the interesting thing about who do you think it's the better deal here, Ford or Tesla in this situation? Basically, Ford has access now to 50%, it's not all of them, 50% of Tesla's charging network. Who has the better deal? Joe, do you know?
Well, seems like a false deal, right? Because for stock price jump, right? But they don't have mutual benefit anyway.
Right, there is. Now, for Ford had the biggest problem with Ford cars right now is anxiety, like range anxiety, it's called. That means if you're driving a car and you run out of gas and you don't have a charging station nearby to charge, you're going to get super anxious about purchasing that car. I mean, that's called range anxiety. And right now Tesla has a moat bigger than any other manufacturer. Let's look at the market share for EV vehicles in 2023. Tesla has 62% of EV vehicles, and they have the biggest charging network in the United States. The biggest problem for Ford is that they don't have their charging networks they're relying on for their cars are not reliable. So the EV charging network in America is not reliable, and that's a major issue. And Ford, it seems like a big win for them because they have access to a large chunk of Tesla charging network. And it might not be. The problem with Tesla is if they go through with this, then you're going to have Ford F-150 trucks in front of you in the Tesla charging network. And that's going to make people not buy Teslas because who wants to sit and wait for a charge and for other types of cars? But what's happening is the government is funding the expansion of these networks. So Tesla could be a big winner here because the government's basically paying for them to expand their network. And this could be the new standard with this is 1/5 of the cars made in America. Ford is going with this standard. So if we have this become the standard in America, some of the other EV charging networks might have to adapt this standard and pay a royalty to Tesla for their supercharging technology. I'm not sure, but it's a big news story for Tesla, I think. And the Tesla positives is they're expanding their network using taxpayer funds. And so if they can get some of these if we see some more news articles saying VW is adapting that standard and Hyundai is adapting the standard, we're going to add up all these market shares and say, wow, it looks like some of the existing EV charging networks going to go under because, there could be a chance where the big get bigger and the small ones don't have enough money to be funded. Because right now it's a money losing situation. The smaller charging network companies are basically expanding and they're losing money just to get that market share. So reliability is very important in charging, and right now Ford doesn't have that reliability in the existing offerings. Okay, so this is really important. And what Tesla is doing is they're reducing the prices to keep this market share, and they're building a network of the battery manufacturing gigafactories so that they reduce the cost of batteries. So they're actually it's going to be hard to compete with them. But if we look at the stock of Tesla, it's been going down. Let's look at Tesla. I update these charts every week. Engine, let's look at it. Yes, right there. It's in a downtrend. If you look at that downtrend, it's becoming more and more. It's coming closer to fair value every day. Fair value meaning, let's look at Tesla. Just the actual 10-year chart. Okay, it's up 6%. So I guess the market is actually seeing that that's a positive for the company, for a major manufacturer to adapt their standard. So they're actually we'll look at some of the positives for Ford now. It looks like Tesla is turning into an ExxonMobil like energy company. So they might take a good portion of ExxonMobil's business away from them. And so this could be a different source of income for Tesla that they don't have now. So what I did was I put together some investing thesis for Tesla. One of Kathy Wood's from the ARC fund, major thesis for the company is robo-taxis. We're not even talking about that now, but if Tesla can allow each of their owners of their vehicles to allow their cars to be used as a robo-taxi in their spare time, Kathy Wood says that's a huge, she uses trillion-dollar industry. The existing taxi business isn't $1 trillion yet, but she makes these weird, well, it could be like an investing thesis why to own Tesla because of that in the future, if that ever happens. One negative thing about the situation is the profit per car is going down over time because they're reducing their prices and you have increased competition. So that's a negative. But that could be countered by maybe manufacturing batteries using a better manufacturing process that's less cost per battery. Let's look at the continued innovation of new products. We know they have everything from Solar City acquisition, so they have roof solar. They have possibility of integrating with SpaceX, because they hinted at that before. They have a charging network that could be the next Exxon Mobil. That could be, and existing charging networks might use their standard, and that could be just a residual income they get from that. They have exclusive deals with cobalt and lithium manufacturers that can produce batteries at lower cost. That could be at scale. That could be in their favor. And I guess the biggest thing that Tesla has going for them, they have the world's richest and most innovative, creative person in the world, and to introduce new products that are not yet known yet. So as Tesla gets towards its fair value, right now it's a little bit overvalued. Right now the numbers show that it's growing around 20% if you average all these out. And their PE is 42. So they're about 2.1 PEG ratio. So they're double the price it should be. So if we look at the price now, it's 196. If it went down to 100, it would be fairly valued. And it was down there. It was down to 100 right around beginning of this year. So it's not out of line if there's a bad market for it to go back down there. So we'll keep an eye on that $100 level as the fair value of Tesla. And if it gets back down there, I'll start dollar costing a little bit into it. All right, so let's look at our next talk. Any questions on that? All right, so we have, I'll just look at the statistics for Tesla. Right now, Yahoo Finance says its PEG ratio is 1.6. So they say it's 1.5 times overvalued, basically. And so it's they say its fair value is around 140. But not the numbers we're looking at for a good company. They're they have good return on equity, so that's great. And they don't have a whole lot of debt either, so that's all in something we're looking for. But they're overvalued, so we'll just wait for that to come back down to a PEG ratio of 1. And let me see. Let's look at some of the market movers for today. See what's going on. We know that it's a good market. Let's look at the big picture. It's the market is basically rallying today. We have a debt deal that's a catalyst. We know it's going to happen. As soon as it happens, buying the rumor, selling the news. It could sell off. AI hype. Yeah, so we had a hype from the NVIDIA earnings, and it seems like all of the AI companies went up with that. We had AMD go up. We had Google go up. Anything that had AI in their press release in the past year went up with that. So you see, okay, that's the big picture in the Yahoo Finance. Look at the market movers. Not now. Okay, Broadcom, they had to deal with Apple to supply the iPhones, so that's huge. That's like 20% of their sales, and they have a dividend. So this could be like a stock that has a growth and a dividend. Broadcom, they make parts for phones for the most part. I don't know anything about these. Ford, that deal with Tesla, that's really good for Ford owners because they'll sell more F-150s if the people that buy the cars know that they have a good network to charge with. So that's the reason there's confidence in Ford. And Ford is near an all-time low right now. I mean, a 25-year low. So that could give Ford a kick in the pants for going up. Okay, Tesla, they're up because they basically could be the next ExxonMobil if their charging becomes a standard. Netflix is up. They just introduced some password sharing problem. They're cracking down on password sharing, and they're going to start making people pay for extra people for sharing, and that could double their sales. It could more. There's a lot of people sharing passwords out there, and I guess Paramount Global could be up in sympathy with that news story because that they go together. Let me see. Okay, the ones going down the most. Let's look. These are all stocks that are conservative. They pay dividends. No, they're conservative. They went up a lot last year. And so we have health companies. We have Albemarle, their lithium producing company with a dividend. Ulta Beauty, that's a high growth stock that sells. Oh, Ulta Beauty said that they have a problem with shoplifting. So their sales were heavily impacted by theft. And that's why I'm kind of leery around retail right now because there's a huge wave across America of theft. In Walgreens, big big chains that Target, there's a lot of theft going on. That's affecting the bottom line of major retailers. So there could be a fad there. We might see the retailers in the top decliners. Let's look at. Okay, that's all we can get from that. Let's look at the market movers for the Nasdaq. Okay, so the news from NVIDIA, where they went up 25%. That's affecting a lot of the suppliers to the chip industry. So. Right now, Marvell Technology, they had a really good earnings report, and on top of that, they're a supplier to the AI industry, so they're up with the AI hype, and so a lot of these companies that are in the top 10 are AI related companies. Maybe we should do a segment on AI. That'd be really cool because AI is becoming. It could be a bubble. It could be just the beginning. We don't know. And we were talking about the metaverse last year. We were determining if that was a 10-year next internet, and that fizzled off. We don't know if AI is going to fizzle off either, but a lot of these companies in the top 10 are AI related. All right, so now the ones in the top decliners, these are the ones that did well last year, basically. O'Reilly Automotive, there's a large percentage of cars that need fixed up. The average age of a car in America is over 10 years old. So that's the investing thesis for all these O'Reilly Automotive. And why it would go down today? I guess everything that did good last year is doing poorly today. T-Mobile was in an uptrend last year. Now it's out of favor. Gilead is a drug stock. So all the drug stocks that were doing good last year are in downtrends. Let's look at our stochastics and look at some of we see Tesla's in a downtrend, but it's starting to have some good news. A lot of the Johnson & Johnson, a lot of the stocks that were doing good last year are starting to go into downtrends. For instance, almost every one of the drug stocks we're following. Let's look at go from the top. Okay, S&P. Okay, we're still sideways. We're potentially breaking out of that now. We don't know. Invest in the QQQ it's definitely in an uptrend, but we're still sideways. Let's look at the healthcare, consumer discretionary. We're in a sideways for that. Let's look at the healthcare. It's fizzling out this year. You can see it's really not doing anything. So that's what I was trying to find there. Okay, so healthcare, all the stocks that did good, they're conservative, pay a dividend for now, and they're being thrown away for anything with AI in the headlines. That's what we get from that. Let's look at, what else can we see here? Oh, the sectors. The sector's doing the best and worst today. Okay, oil. Let's say oil, why would oil go down? Just with the price of oil, I guess. Healthcare. You can see all the sectors that did good last year. These are all, yeah, that's it. All the sectors that did good last year that were conservative and paid a dividend, they're out of favor now. The ones that are doing the best are the semiconductors and technology, everything that did poorly last year. And financial. Okay, so it's a total reversal of last year. So we're going to see a lot of that this year, where we have a return to the mean. Everything. So it seems like the stock market likes to oversell things, and also it does the opposite thing. It overbuys things, and you have to be willing to go up and down. Oh, look at that. You have to be willing to handle that volatility as an adult investor. Okay, we have a debt ceiling negotiators close to a deal. We know it's going to happen. It's just going to be a catalyst for people to feel good around the holiday. See. All right, so that gives a good overview. Any questions? Anything you wanted to go over? All right.
So the one thing I guess I would be interested in the AI discussion is why is NVIDIA so well positioned compared to like AMD or Intel for the AI hardware?
One thing that Jim Cramer says, Jim Cramer has been on the NVIDIA trade for like years. He's had it in his top holdings for like, I don't know how many years, and he hasn't sold, in the volatility. I think what Jim Cramer says is they have an advantage with their software stack. They have an existing API or whatever it is that you can implement and start using it with half the AI stuff already together, and you just use it, right? And you deploy your networks and data centers. And I don't know anything about AI. I know enough from college, but everything is changing so much. I can't really grasp what a software stack is for that. But they actually provide like a solution that others don't. I mean, because Intel and AMD actually they went into a deal with, I think, Microsoft to implement. And so Microsoft and AMD are teaming up there, but it seems like.
So the thing about AI is it requires data to have a smart solution, right? One of the data deep company like Google, Microsoft, Amazon, they have their own AI software stack. So I'm kind of wondering what NVIDIA potential AI user would be, or customer would be, given that they have to compete with data deep Google, big company like Google, Amazon.
I'm not sure exactly what a GPU is, but I think NVIDIA has that offering for data centers that no other company has, that has something similar to it. I guess we'll have to research that to figure out what a GPU is and why data centers will have to be using that technology. Because I think what Jim Cramer says is that it's so much it adds so much capability for these data centers to add this GPU, to their offerings. I don't know, but they have that solution that no one else has. I have to research. I don't know a whole lot about that. But it seems like AMD and Microsoft could be partnering because Microsoft has that OpenAI solution, and that's why AMD popped. Because if Microsoft and AMD team up for a similar solution, they might be that competitor to NVIDIA. I'm not sure enough to understand that. Matthew, do you know anything about that?
I don't know. I do know that to use the like parallel instructions in like NVIDIA, you need, they use their like, I think it's the CUDA, the CUDA API, and that's, maybe there's other stacks in some way depend on the hardware to be able to do it at scale and for an affordable price. You need that like hardware solution with their specific proprietary API into their hardware.
Right. So yeah, that's something I don't really understand. But if they had that CUDA, software, then that could be their temporary solution. Once you have an API and half the work is done for you for AI, you're gonna rely on that and demand other, your network to be using that chip technology. I don't know.
It would be a good news. It would be a good news if NVIDIA and Amazon second on the cloud solution AI.
That would be huge news.
Right.
That's similar to AMD
right
and
now,
Microsoft.
heading to the clouds, and Amazon introduced its own software stack for the cloud for AI. And I'm trying to picture where NVIDIA would be in terms of customer-wise, demand-wise, or market-wise, when competing with the like of Amazon.
Right. I think Amazon is coming up with their own AI solution for their AWS. So you have
How
like
come
a
many
competitor
use it?
there.
How come many use it?
I don't know.
You saw the town hall meeting yesterday, right?
Right.
One of the guy was saying that they use AI from the cloud solution and cut down a lot of costs.
Yeah, I think Microsoft and AMD could have a good competitor to this NVIDIA because ChatGPT is like huge buzzword for implementation of AI for corporations, and Microsoft is really good at making STDs and APIs, SDKs, and APIs. So I don't know. I think it's a good competition. I don't know a whole lot about it. I think we could go through a session going through AI and what it means, and
it would be funny if not really funny, but next year presidential race, and then suddenly somebody asked ChatGPT a question politically, and it blow up in the air.
Yeah.
And then ChatGPT gonna fell down to us, and then what happened to AI community?
Yeah, there's a big headline problem with ChatGPT and some of these AIs just going off the deep end and doing things that are like making political statements or making some statements about people that are not socially acceptable. That's definitely within the realm of possibility, but I don't know. And also it's being regulated in countries like Europe. Like Europe is saying ChatGPT can't be used in these ways, and then it could be a technology that's not really usable after regulation. I don't know. That's kind of, as investors, you can't put all your money in one. Like last year, we were talking about metaverse. That could be the next thing, and it turns out it isn't. And we have to, it's the same thing with AI right now. It could be, with all these AI companies going up recently, 25% a day. Marvell AI news story, 9%. It could be a big bubble, and you can't just like put your money into the AI companies. What if it's a metaverse? What if it's a Google Glass? We don't know. That's why you have to be diversified.
When you're talking about metaverse, the stock price going up.
Well, when you're investing, you have to be diversified, and like I have a good portion of my portfolio in Facebook, and I thought if metaverse actually came to be, they would probably at the top of that, that technology. So, but it's only a fraction, like less than 1% of my portfolio. So, I guess for AI, you have to really keep in mind it might be a bubble. You can't put all your eggs in one basket, and you have to evaluate, like we're doing this week. Is it a real thing? It could displace Google. If someone can say, put together a vacation for me, buy me this product at the least cost, or if AI could do that reliable, well, you're not going to be searching through websites to find your answer, and that could seriously, I can see it seriously displacing Google as ad related company. So you have to really keep that in mind. Whenever I have a position like 25% of one stock, and there's challenges to that business model, you have to really take that in mind. These are hints. These are like red flags. And as soon as you have these red flags add up and the technology proves itself, you got to really consider, for Google or Alphabet, you got to consider, it has these other things that will replace that product, going forward. We don't know, but you have to reduce your exposure to that threat in the future. So that's kind of a hard thing, evaluating new technology to see if it's going to be good or not. That's why we all have ChatGPT sessions and we're testing it out. And if it could be a replacement for our search as we know it. So we'll do a session in the future about the AI and AI companies, and just like we did Metaverse last year, to see if what companies could benefit from that, and if any of them are fairly valued, and we can look into it.